Okay, now we're going ahead and continuing with journal entries for the second half of December. On December 16th, I received $3,100 from fees earned for the first half of December. So what this means is that I provided people services, they paid me cash. I got money, I debit the cash, I credit the fees earned. So I increase my money, I increase my revenue. Now, when you provide services, only two things actually will ever happen. They'll either pay you immediately or they'll pay you later on. When they agree to pay you later, it's called an accounts receivable. This is an asset, so the rules of asset for debit and credit apply. So even though I haven't actually got the money, the revenue is still considered earned, but I haven't received it. So here's what my journal entry is going to look like on this. Fees earned on account total $1,750 for the first half of December. So there's no cash involved, but I increased my accounts receivable with a debit and I increased my revenue account with a credit. Remember, fees earned is revenue. I always only credit it until I tell you otherwise. December 20th, I paid $900 to Executive Supply Company on the $1,800 debt I owed from the fourth transaction. So I spent money, $900. That tells me I credit the cash. The debit will be to accounts payable. So here's what my journal entry will look like. Here's the T accounts, just to show you what these are looking like down here. Decrease my cash, decrease what I owe. On December 21st, I received $650 cash from customers in payment of their accounts. Now here's what happened. I got money. My customers who owed me money paid me. So I'm only going to use cash and accounts receivable. Cash I got, debit, and accounts receivable is credited. So customers are paying what they owe me. So what I'm actually doing is decreasing how much people owe me with this. On December 23rd, I paid $1,450 for supplies. I went to the store, I took cash, and I spent money. When I spend money, I credit. And what did I buy? I bought supplies. I'm going to debit. So here's what my T accounts would look like down here. Let's move on. On December 27th, I paid $1,200 for wages. When I spend the money, I credit the cash. And what did I pay for? I paid for wage expense. I debit. Again, expenses are always only debited. So here's my journal entry. Here's what's happening down in the T account or the accounting equation. This is just an example of what's showing the impact on the equation. Okay, on December 31st, I paid $310 for my telephone bill. That is considered a utility because I spent the money, I credit the cash, and I'm debiting my expense. Again, here's the impact of this transaction on the equation. Now I'm paying my electric bill, $225. Again, same type of transaction, credit the cash, debit the utilities expense. December 31st, I received $2,870 for fees earned for the second half of December. So I actually got money for providing services. Get money, debit cash. Remember that. It's 95% of the journal entry. What did I get money for? For fees earned. And here's what it looks like down here in the equation. I get more cash. I now have more revenue. Okay, on December 31st, fees earned on account totaled $1,120. This is not cash. I didn't get money, but I did earn revenue of $1,120. So I'm going to credit my revenue, and the customers owe me money. The key word here is on account. On account is accounts receivable if you're providing a service. If you're buying on account, it's accounts payable. So here's the transaction for this one. As you work through the homework, I want you to go back and look at these transactions. It will help you try to figure them out. Okay, last transaction, I paid $2,000 of dividends. So I spent money, I credit it, and dividends is only a debit until I tell you otherwise. And here's the effect on the accounting equation. So what I'm going to show you next are going to be the general ledger accounts after all of these journal entries were posted. So I know it might be a little bit hard to see, but here's my cash account. So we posted all of December's transactions. So here's how I posted them. Notice there's nothing in the credit column because this is an asset and normal balance is a debit balance for an asset. So all of these columns are added to the previous balance where these columns are subtracted. And here's my accounts receivable asset. So nothing over here. Supplies, asset, nothing on this side. Prepaid insurance, asset, nothing here. Land, nothing here. Office equipment, it's an asset, so nothing on the credit side. Now we move to accounts payable. It's a liability. The normal balance is credit, so notice there's nothing written here on the debit side. The same thing with unearned rent, common stock, dividends. So take a look at these. Look at revenue. Normal balance is credit. That's why nothing is ever debited. Here's all my expenses. Look, nothing in the credit side because the normal balance is a debit balance. So this concludes the posting.